Hi, everyone. Thanks so much for attending today. We're pretty excited to have everybody here today, and a special thank you to you all for taking time out of your day to actually watch an hour of the workings, the inner workings of your participating policy that you own, or ones that you may even be considering. You often get to hear about our extended team, and you often get to hear about, our team, which I'm very grateful for our team right now setting up these webinars, because of course, without them, these webinars wouldn't happen. And of course, for those of you that are watching from home, I want to thank you for your time as well. And of course, without your guys' great questions, we wouldn't probably be having these sessions as much. So we're trying to always keep you informed of what's going on, keep you aware of some new ideas, keep you aware of how you can work your products again to your financial situations. So we're pretty excited to actually introduce one of our extended team members, Barry Rendell, and have him as part of the presentation today. Barry's been working with us and with the Canada Life group of companies for about 30 years as a technical specialist throughout his life for affluent clients, multi-generations, business owners, doing some estate planning as well as charitable planning with us. And today we're pretty excited to actually have him be part of the call. He's a native Albertan, of course. And sadly, as you all know, my whole team are Oilers fans pretty much, other than me. So I'm the Flames fan in this group here. So welcome, Barry. We'll like you anyway and listen to you today anyway.
Thanks. I didn't wear my jersey. Yeah. Well, good afternoon, everyone. I appreciate the opportunity to speak with you. As Pam said, I've been with the Canada Life group of companies, started with the Great-West Life, London Life side of things. And just as a bit of recent history, we amalgamated as under one brand of Canada Life in 2020. So we are now just Canada Life. So the Great-West Life, London Life platforms have been amalgamated with Canada Life. So we're one big happy family now. And so I support advisors and advisor firms like the Tower Group in supporting Canada Life insurance policies. And I work across the province of Alberta. So I support advisor firms on their kind of more complex life insurance cases and help where I can as far as helping clients see the purposes and the uses of our insurance policies. So we'll go through a few different ideas of how insurance is utilized, and open to any questions that you might have. And we'll go through a case study of a couple of clients that might be similar to your situation that we'll go through and see how insurance products have helped them. This is just our disclaimer slide that we typically have in our presentations that show that I can't be held accountable for anything I say today. So please don't hold it against me. Next slide, please, Trish. So what we're going to talk about an estate transfer, and this is a terminology that we use for what we call, I use the expression lazy cash quite often. People have excess cash flow, and we talk about corporations quite often as well. We're going to talk mainly on the personal side today. If you have excess cash flow, what do you do with that? What are your options? So we have a strategy in the insurance world called the estate transfer, where you move, those lazy assets or tax-exposed investments into an insurance policy to give you the opportunity to not have to pay tax on the growth, obviously, within that insurance policy. It is tax exempt. We'll talk more about that in a moment. We'll talk about the taxations of non-registered investments and how that can be a sticky point for some clients when they're being taxed on the growth within those portfolios. Insurance is part of your overall net worth. We often talk about participating insurance in particular as part of their overall asset class, and we'll talk about the different characteristics of each of the asset classes that you may hold within your own portfolio. The estate transfer strategy, which compares utilizing the insurance policy or having that money invested in your existing investment portfolio. And we'll talk about the taxations of the insurance difference, the tax exposed nature of the non-registered investments versus the tax exempt nature of insurance policies, which I'm sure you're already quite familiar with. We'll go through our case study, and then obviously one of the uses that we talk about life insurance quite often is the accessing cash. Oftentimes we find clients, they see the need for life insurance, or they want to put some insurance in place for the benefit of their family should something happen to them, or to pay a tax liability upon death, those types of things for estate planning. But we often don't talk as much about what we can do with that policy during our lifetime. So we'll talk about how we can access the cash within that cash value life insurance policy, particularly participating life insurance policies, which Canada Life, as you probably already know, is quite a big player in in the participating market. Just as a bit of recent background, as of Q1, we have our PAR account report that we can certainly share with the Tower Group, and they can share with yourselves as well. But we almost got to the $50 billion mark for the size of our PAR account. We're at $49.67 billion for our PAR account assets. So by far the largest PAR account in Canada. Most of that is our open block. So, all of that is our open block. We've got about a $6 billion closed block, and we'll talk a little bit about that perhaps later in the presentation if you would want to get down to the specifics of our PAR account, which I think some of you may have seen the presentation yesterday that went into the inner workings of the assets within the PAR account and our investment philosophy. So I encourage you to see that presentation if you haven't already seen that as well.
Definitely, and reach out if you haven't gotten the link and you would like the link and would like to watch that. Trish can send you out the link. That'll be on our YouTube page as well, or if you've subscribed to our YouTube page, please do that. That'll always be there, and any updates that we have will always be on there as well.
Sounds great. Next slide, please, Trish. So I often show this graphic, and what this basically means is we spend most of our 20s, 30s, 40s, and our 50s is growing our asset base, and we're growing our assets to provide for retirement and do the things that we want to do that we really like to do. I've used the expression quite often, I work so I can do the things that I want to do, and I save so I can do the things that I want to do when I don't feel like working anymore. Now, one thing that this graph shows is it shows us accessing those assets, and it shows a decreasing balance, if you will, as far as accessing. Oftentimes we see clients that accessing section of that graph is actually increasing still. We're not using all the money that we have in that pool that we've accumulated over those years. So that accessing piece is ever increasing. So our tax bill is ever increasing on an annual basis. And then there's a lot more that's left over in that transfer piece, that green piece at the bottom there that we're typically transferring to the next generation. So what can we do with that excess cash? And that's oftentimes what I find myself in client situations, talking to clients about, their retirement plan, how much they have earmarked for their retirement income needs, and what they do with the excess, and what we can provide as far as opportunities for them to consider.
Yeah, and the way I like to differentiate that for clients as well is we know that the priority is yourself, your retirement, and your retirement income. And this brings quite a bit of stability to your retirement income stream, but then it gives you the choice and the freedom to spend all the funds that you've accumulated. And then by default, if and when there's excess to transition, this just makes it that much smoother because obviously there's a tax-free payout there. So yeah, perfect.
One of the things I've used as an expression quite often as well, particularly with clients that are in their older years, is I use the term mature simplicity quite often. People have some fairly sophisticated investment portfolios in their 40s, 50s, and 60s. They get into their 70s, 80s, and 90s now. We're seeing a lot of clients that are living a lot longer. They don't necessarily want to have to make all those investment decisions all the time. So if we have a portion of our investment portfolio within something as solid and as stable as a life insurance policy, it doesn't require them to make those decisions on a regular basis. So we can keep that piece, it's that safe asset or portion of their assets that's not going to require a lot of input on their part. Next slide, please. So just as a bit of background, so when you have a non-registered investment, as you well know, I'm sure, there is taxation paid on that. If you have a fixed income asset, it's 100% taxable, the growth within that portfolio, tax it as up to the highest marginal tax rate of 48% here in Alberta. If you live in other provinces of the country, I guess we're the lucky ones here in Alberta. We used to be really lucky at a 39% marginal tax rate, but now at 48, we're still the lowest in the country. As far as the highest marginal tax rate, we've got other provinces that are at 54%, but you are getting taxed on that growth. So there is that, we call it a tax grind. Every year you're paying tax on that non-registered investment portfolio. So at the end of life, there might be some tax on some unrealized gains if you have some capital gains within your portfolio that are realized or disposed of upon death. So that could create a tax liability upon death as well, and then the remaining assets would then go to your estate. Next slide, please. So when we talk about life insurance as part of your overall net worth, and we call it, the expression we use quite often is PAR as an asset class. So a lot of people don't necessarily think of life insurance as an asset. They think of it as a liability. Well, I need insurance to protect my family in the case of my premature death. And they see the value in that, but they don't necessarily see it as an asset. So when we talk about particularly the cash value participating life insurance policies that we're going to primarily talk about today, we can put that in the same category as our other fixed income investments, our equity investments, any business or real estate assets that we have. That life insurance is seen as in that same category. Now, each of those particular asset classes have different characteristics when it comes to the growth, certainly the risk, as you have different assets within your investment portfolio. Some of them have very different risk characteristics. The tax treatment, how those fixed income and equity investments, the real estate investments are taxed, certainly very different. And obviously life insurance being that tax preferred vehicle doesn't have that tax treatment during the growth of that policy. And upon death, that death benefit's paid out tax-free. We'll talk about more about that as well. So the distribution aspect of each of those asset classes can be different as well. So life insurance can play a very significant role in that overall net worth that many clients see as a valuable piece. Now, just for a bit of background, I'm not sure if many of you were aware, the Department of Finance decided, well, I actually started the process about 13 years prior to 2017, but it took them that long to kind of finalize what they're going to do. They wanted to change the tax exempt rules. And those tax exempt rules had been in place since 1982. So they hadn't changed for quite some period of time. And in 2017, they came out January 1st of 2017, every insurance carrier in Canada had to basically revamp all of their insurance product shelves to make sure they stayed within those tax exempt limits. The government said, okay, we're having too many clients that are taking advantage of you, if you will, as far as using life insurance and the tax exempt limits within the existing pre-2017 rules to put a lot of money into an insurance policy, which is subsequently not resulting in them paying a lot of tax to the government. So they changed the tax rules. So policies prior to 2017 in that red dashed line, we're using the previous rules, which was basically just in a nutshell, it's based on a 20-year endowment. So you can see that the curve goes up less steeply than the blue line, but it also has a higher limit for those years from 20 up to 40 in this example. So that means there's more tax exempt growth room within that policy, and this is just a benchmark policy that we're using as an example. They changed the rules so that the limit is going to be now based on an 8-year endowment. So you see that blue line, it's quite steep, but it kind of flattens out at year 8 and beyond. So it's got a lower tax exempt limit. And we've also increased the year in which that endowment, sort of this cash surrender value of this policy, equals the death benefit. Because of life expectancy and mortality tables, we've started using more up-to-date mortality tables. Clients are living longer. So the government decided we needed to stretch that out to age 90 as opposed to age 85. So what that means is you can have less cash sitting within your policy on a tax exempt basis. So policies that were put in place prior to 2017 are grandfathered. So they've got the old rules still in place, which is fantastic. So I often talk to clients that have existing policies prior to that January 1st, 2017 cutoff that please don't do anything with your policies that's going to potentially lose its tax or its grandfathered status. And if you were to get rid of a policy like that, it would probably be detrimental as well because you wouldn't be able to replace it with something that could be sold currently. The currently priced products are still very strong, and we are still very active in the life insurance market for the purposes that we're going to talk about. But the rules prior to 2017 were even a little bit more favorable in the fact that you could put more money into an insurance policy on a tax exempt basis.
And that kind of answers one of the questions that we were asked is, can CRA change the rules? They certainly, that's one guarantee that none of us can guarantee is that something won't change into the future. But historically, they've always grandfathered the policies other than the 1-10-8 strategy that they kind of blew up for sure and said, no, justifiably so. We didn't really believe in that impact either. But they've always grandfathered policies in the past. So, we're hoping they keep that same mandate and continue to do that going forward for sure.
For sure. And I'm sure that Pam and Kelly were extremely busy in 2016 because we were told what the rules were going to be. And we had a lot of time to, like I say, to revamp those products so we can say, okay, is my client going to benefit from buying a policy now versus waiting until after January 1st of 2017? So there was a lot of activity in that year prior to the rules taking effect. And as Pam said, those rules would typically be grandfathered. So whenever we have a situation where the life insurance is going to be impacted from a taxation standpoint, we typically have that grandfathered status on existing policies that we can carry forward. So that's always good news. Now, as far as the estate transfer strategy, we talk about the non-registered component of your portfolio and the annual tax on growth and the tax upon death. The estate gets the remaining funds. With premium payments, obviously, within an insurance policy, there is no tax on that growth. That policy is tax exempt, so the growth within that policy is tax-free. When you die, the taxes, the death benefit is paid tax-free, which is another great benefit to life insurance. And that's one of the main purposes that many clients buy the insurance for is that tax-free death benefit that goes to their beneficiaries, typically their dependents that would require financial support in the event of their untimely death. Now, some of the things that we typically have clients name their beneficiaries to provide that initial payout that can grow over time. We want to enhance the policyholder's estate in later years, so we typically show a product that's going to have growth within it. When the dividends get credited to a policy, that will buy what we call paid up additions. So the death benefit is going to grow with those paid up additions within the policy. So if you did have that tax liability that you wanted to utilize life insurance to fund, that tax liability is typically growing as well. If you've got whether it's a business or a rental property or a summer home, those values are typically growing. Obviously right now, everything is growing at record numbers. I think 7.6 was the inflation rate I heard today, and that's the highest it's been since 1983, I believe. So this is certainly a very trying time for many people, and obviously with those assets growing in value, those tax liabilities are going to subsequently increase as well. Many people have leave a legacy as a prime purpose for the insurance once they get to a point where they're putting this type of asset allocation into their insurance policy versus their investment portfolio. They want to maximize that legacy that they're leaving to the subsequent generations. And we talk about clients' children, but we also talk about their grandchildren. And many people that I run into on a regular basis, they like their kids, but they really love their grandchildren. So they really want to make sure that those grandchildren are seeing that grandma and grandpa took good care of them and wanted to leave that legacy. We often talk about strategies like cascading life insurance, where we can purchase a policy on, let's say a grandparent would purchase a policy on their child, their adult child that would also have grandchildren, with the grandchildren being the ultimate beneficiary. So it's a way of moving that wealth from one generation to the next on a tax-free basis that doesn't, like I say, have that tax liability upon their death with disposition of assets that many of you might be aware of already.
And that's what we find in practice, is that the objective is the retirement income and the cash value tax sheltered. And it looks brilliant, if you give it enough time to work when you compare it against the high tax fixed income. And then the insurance tax-free payout is almost like a strategic byproduct of that. And then as they age and as grandchildren maybe show up to this scenario, all of a sudden we're asked that question, like if I could impact that generation with some smart tax planning, how do we do that? And we often go back to say, well, we've already got that in place because we try to start this as early as possible. Or if there's no kids or grandkids on the scene, it's interesting when we look at like a final testamentary tax return, let's say at age 90 for life expectancy, and what happens to your assets. A shocking percentage does go to CRA for tax. And again, if you're using this as a tax sheltered vehicle, a lot of people find comfort or excitement in the sense of like directing that to another party, like a charity or a church or some other cause that's important to them, as opposed to just going over to tax. So
and that's something that's always, sorry, Kelly, did I cut you off there?
That's perfect, yeah.
That's something I was going to say that, you always want to keep in mind is, a lot of people are often surprised when we're still having those conversations with the tax rates chipping up and chipping up and chipping up. You're now seeing people's RSPs when they pass away are taxable at 46.9%. So a lot of people are coming to us going, well, hey, before the TFSA limits used to be 10, now they're not, they're lowered. And really the government makes those changes and says, here's the max you can put in, and here's the max you can put in TFSAs and RSPs, because they don't want people putting away more and more money that are considered the wealthy. That's why he keeps talking about this middle, estate strategy of, hey, we're going to help the middle class. And we're going to help that middle class all through, which really ends up being the lower class of people versus, really a middle class or upper class. Because a lot of wealthy people have nowhere else to put their money other than into a tax shelter like this. And that's where we start talking about this to make sure that, you have enough for your estate, number one, that should your RSPs come due and the cottages you might have and things like that. It's like all of a sudden, it's like you're in a taxable situation that causes a problem that you're feeling awkward with in the end. And that's really where we get the right amount of estate. And we use Barry to kind of figure out what's the right amount for everybody. And then how much can we tax shelter inside this as well to get the maximum benefit for you?
For sure. And I think it's really helpful for Pam and Kelly and other advisors to go through with their clients and have their tax experts involved and say, okay, what is my tax liability? the earlier you can get educated on what my current tax liability is and then what we can project that to grow to at, a point in time, whether it's age 85 or 90 down the road where I expect my life expectancy, we need to make sure that we are aware of what is taxable and how taxed will it be. One of the things that the government keeps talking about, and I think everybody was kind of expecting that it might happen this year, is the capital gains inclusion rate. If you've got a summer property that would be subject to capital gains, the inclusion rate is currently 50%. Well, if that was increased to 75%, what would my tax exposure be if I had an asset that was going to be trigger capital gains upon my death? So just making sure that we have that evaluation and knowing what our tax liability is, because I think that is somewhat surprising to some clients to see what that number might actually be. So what this estate transfer strategy, it's great for people that need life insurance and understand the value of the benefit of having that insurance policy, particularly permanent insurance. Obviously, term insurance is a great product for a shorter term need. I often don't recommend term insurance for this type of planning because it does have an expiration date. Our term policies, and I'm not sure of any term policies in the industry that go past age 85. So if you do live past age 85, not only are you paying those renewal premiums, because term insurance does go up with each renewal, if it was a 10-year term as an example. So it's more designed for temporary needs. So we would put permanent life insurance in place for clients that see the value of that long-term asset that they're going to have pay out that death benefit upon their death. When they have annual tax obligations from investments, this is where we can talk about that asset diversification and carving out a piece of their existing portfolio and moving that into an insurance policy. And I use the expression quite often, we're moving it from pocket A to pocket B. So we're not asking clients to come up with more money. We're just saying, okay, let's reallocate some of your existing assets, move those into this investment vehicle we call life insurance that does have the cash value components that Kelly was talking about, and obviously the other great things that life insurance has to offer as well. But it's reallocating some of your existing assets into that insurance. So it's not asking you to come up with more premium dollars to go into that insurance policy. So if a client has the desire to reduce the taxes on their investment income, they do have that hot button of paying tax every year on their non-registered portfolio. And if it's that lazy cash I talked about earlier, that GIC that, let's say, a grandparent was looking to just earmark for the next generation or for their grandkids, they're paying tax at 100% interest income on those GIC portfolios. Is that really something that they want to continue to do, or can we look at other opportunities to move some of that into an insurance policy? Obviously, as we talked about, the clients that want to leave a legacy, life insurance is obviously a great estate multiplier for that goal. Instead of just having $100 of their assets going to those subsequent generations, we can multiply that by using those assets and buying an insurance policy that would obviously have a much larger impact on those subsequent generations. And then obviously the accessing cash value from an insurance policy. I talk about three primary methods of accessing cash value quite often within a life insurance policy, and there is a fourth option as well. And if you already have a participating life insurance policy and it's under paid up additions as the dividend option, which means as dividends are credited, you buy more insurance, so your insurance death benefit is going to continue to increase. But you can switch that dividend option to cash at some point in time in the future. So you're just going to be paid a tax or cash dividend each year, as opposed to having that stay within the policy and buying more insurance. So that's another option. That's the fourth option that I often talk about as far as accessing cash. And we'll talk about each of the three other options and their individual merits as well in a moment. So within our estate transfer strategy, this is, like I say, this is what we call the tax grind. So if we're looking at this graph, we've got contributions. We're just using an example of a 50-year-old client, $25,000 a year of excess income that they don't necessarily need for lifestyle. They're just going to put that into an investment portfolio. Well, let's look at the options of doing either of those two things, whether in the investment or in the insurance option. So we did that $500,000 over that 20-year period, $25,000 a year, and we didn't have any tax to pay on that. We lived in a utopian society. There was no tax payable. We would grow that to almost 1.7 million. I'm reading that number correctly. It's a little small on my screen. But because we do not live in a utopian society, we do have to pay tax on the growth within that non-registered tax exposed vehicle. We're going to lose almost $753,000 to tax over this 35-year period. This is going out to age 85. So this 50-year-old client that's putting this $25,000 in for 20 years is going to pay $753,000 of tax based on our 48% marginal tax rate. And I oftentimes see clients, when they see that number, they're like, well, wow, that's a big number. When you look at over a period of time, just that, like I say, that tax grind, how much we're losing to tax, they really get interested in hearing if there's other options that we can consider as far as utilizing something like a life insurance policy. So in the bottom there, that's where we put that same $25,000 a year for 20 years into an insurance policy. Because there is no tax payable on the growth within the policy, we've got a $1.7 million estate value that would go to the subsequent generations, the named beneficiary on that policy. So at the bottom, you've got the same amount going into each of those options, $500,000. You've got 943 as the net estate value of the investment portfolio, with 1.7 million being the life insurance value. So $768,000 difference, or 81% advantage over the investment portfolio. And that's just with the death benefit. We're going to talk about the accessing opportunity and utilizing that cash value in your lifetime as well in a few slides. Any comments about that, you guys?
I don't think so. I think for me, it's almost like the analogy of having your cake and eating it too. If we think about this as your personal balance sheet, it's like we're going to have to hold a portion of your assets or your investment assets in fixed income or conservative holdings somehow. And if we, again, give it enough time to work, like 10 years plus, this exceeds that cash value growth in your conservative assets because there's no tax. And then the insurance is almost like a bonus or a benefit. But when you run the numbers, which we can do on a case-by-case consult, it's sometimes like shocking or hugely surprising in terms of like just the net difference or the net impact. In this case, it's hundreds of thousands, but often it's into the millions.
For sure, absolutely.
Yeah, and as you guys have questions, we want this to be as interactive as possible. So if you have questions that you're kind of going, hey, how does this work? Oh, I'm thinking about this from this part of the presentation. Just put them in the chat or questions section. You'll see Trisha kind of put a little message there just saying, hey, you can fire out questions to us here and we'll pick them up throughout our presentation here and we'll make sure that we're answering them as we go. And Trish will kind of interrupt us and tell us that there's some questions in here and we'll get them answered through the whole thing here, whole presentation.
Sounds great. So in that report that we can provide to through Kelly and Pam, we could be more specific to your situation if you like. We can show that how taxes can erode wealth, and we show that chart that shows the amount lost to tax over a period of time, and just how tax advantage we can move those assets into an insurance policy, how the insurance advantage would compare with the investment portfolio, and we can use different assumptions. I was using a 4% fixed income growth rate in that example. So depending on your situation, we can show different tax characteristics and tax rates and growth rates and everything else. We often show when the policy owner breaks even, and when we have two essential types of participating life insurance. We have our wealth products, which are early value products, and we have our estate products, which are our delayed value products. So when you look at the two products side by side, you're going to see higher cash surrender value in the early years for the wealth products, and you're going to see higher cash surrender values and death benefits in the later years for the estate products. So I often kind of somewhat facetiously say to a client, how far down on the ledger are you looking when I show you a life insurance illustration as an example? If you're looking in the first 10 years, then the wealth product would probably be the right choice for you as far as seeing that value in those early years. Particularly business owners, they like to be above water, have the cash surrender value surpass the amount of premium they paid into that policy earlier rather than later. And this is that break-even point that we talk about. The point at which the cash surrender value is now higher than what they've actually paid into the policy.
Yeah, and definitely. And we often see even people come to us and say, hey, as part of my retirement plan, I'd like to actually spend more here. I want that cottage, or I want certain things here versus, hey, I want that after 80. A lot of people kind of say, well, you know what, I might not live as active as life after 85, 90, and so it's like, hey, can you modify the retirement plan to show more cash here, less cash there? And that's where also you can manipulate these so that, again, like you choose the right product really for what your whole plan is.
For
and
sure.
Typically that ideal is using that cash value in your 70s and 80s. So that's kind of the window where we want the cash value to peak and have access to it, because what we're really focused on is obviously using this as one source of layering in income to a very tax efficient retirement income. So it's almost trying to attract some streams of income from different sources to create a river of your cash flow to support your retirement lifestyle.
Yeah.
Sure. So this estate transfer output would compare that life insurance to investments, and we have some detailed pages in there as well. If you're a little bit more analytical and you want to see kind of the year-over-year comparison, we can show that as well. So it's a very comprehensive report. Next slide, please. So we're going to go through a quick case study. So we've got Dale and Joy. So Dale's a 55-year-old electrical engineer. His annual income is $150,000. We've got Joy, who's a 53-year-old private equity firm employee, annual income of $200,000. They have one child. We've got Liam, who's a high school student, and they've fully funded their tax-free savings accounts, the TFSA. Right now, I think we've got an $81,500 limit for TFSA. So a lot of people are maximizing that, making sure that they can take advantage of the things that the government has put out for us to grow our assets tax-free. We've talked about RSPs, and I run into situations, particularly with wealthier clients. When they turn 71, I was actually in a golf tournament last weekend with one of our advisor firms, and they had a 71-year-old or client that was turning 71 this year playing in our group, and he was commenting that, yeah, I've got to make some decisions this year because my RSP is gonna need to be transferred to a RIF. And what we find is a lot of clients in that situation, they have to start taking the minimum out of that registered retirement income fund, and they don't need the assets. So a lot of times we're looking at options as far as saying, well, how do we reinvest those assets that they're taking out of their RSPs? Can we take those assets out a little bit quicker and move them into a tax preferred vehicle like life insurance and have that benefit them and certainly benefit their estate? They're not paying as much tax on their investment or their earned income that year. The RIF income is going to be decreasing, and we're going to be able to tax shelter a lot more of their assets through the life insurance policy. But won't get too deep into that. Back to our clients, they've got registered education savings plans for Liam for his post-secondary education, and they've got $25,000 of annual excess cash flow that they don't really have any need for at this point. So we're going to talk to them about some options of what they can do with that money.
And I just want to segue, because I know we've got a lot of clients this year, especially, that have taken that time off work and kind of test-driven pre-retirement, semi-retirement, if you want to call it that. COVID's kind of given a lot of people that option over the last couple of years to say, hey, do I want to continue working? And a lot of people have kind of, made a move to a different province. Some have decided to go into different careers or kind of consult when they want to and then otherwise not work. And I think, just like Barry, you were talking about, is people do come to us and go, what am I going to do with my RSPs? I'm now 55 or 56 or some are 60. And it's like, you have that runway to 71. And if you have no other income, great time to start trying to see if we can peel off some of that RSP at a way lower tax rate and put it somewhere more efficient. And that's where this works really well. And for people who have it, it's like, yeah, let's use that to do that for sure.
And what you're talking about there, Pam, is that it's not necessarily tied to income. Like some people say, okay, well, when I don't have an active income anymore, I can't fund the contract or the tax shelter. And in reality, it's more tied to your balance sheet. So in the example here, it's like from an RSP or from a RIF, or same thing, right? Even after you're done your working life, we might choose to fund the insurance tax shelter from your non-registered pool of assets, just to again be more tax efficient.
I do have a quick question here, guys. Sorry, this backs up to a slide, but so the question is, I missed a bit of your comment on putting your dividend into cash instead of buying additional insurance. At what point can I do this within my policy?
At any time, you can change the dividend option. So if you started the policy with paid up additions as a dividend option, which means the dividends are going to be buying more insurance. So, and we typically use, $1 of dividend would pay about buy about $3 of paid up insurance. So those paid up additions can be, the dividend option can be paid or changed from paid up additions to cash at any point. So the dividends, once credited to that policy on its policy anniversary, would be paid in cash as opposed to staying within the policy and buying more insurance.
But I think the dividend options, like in either scenario, what I think our role would be was to say, okay, well, why would you need that? Like, is it for active income or within a contract? What is the best long-term way to get the most out of the policy in terms of cash value and death benefit? Or a lot of times the focus is just on cash value and really how it's structured for paid up additions and reinvestment there to get the compounding growth and a larger dividend the next year. That typically is the leading alternative, but absolutely it warrants conversation or consideration there.
For sure. Hope that answered the question. So with Dale and Joy, we've done, Pam and Kelly have done a great job of looking at their retirement plan, and they've got more wealth than they need in their lifetime to support their lifestyle needs. And I oftentimes find clients, when we're talking about their retirement income needs and what they expect they're going to need, a lot of people have some very grandiose plans of traveling for the next 25, 30 years in their retirement. And what we end up seeing as clients are like 5, 6, 10 years into their retirement, they haven't been doing as much of the traveling as they thought they might. They're kind of happy to spend time with the grandkids, and their income needs don't seem to be quite as high as they maybe initially intended. And I think that's great. Like, be more aggressive in your expectation of what my income need is going to be, and then more conservative of what my investment portfolio can actually support. But then when we find that they've got this excess wealth that they don't have a need for in their lifetime, then we can start talking about some of the options that we can look at. So for Dale and Joy, they're risk and debt averse, so they don't like a lot of debt, and they don't want to take a lot of risk in their investment portfolio, and they want flexibility with payments. And we'll talk about how flexible life insurance premiums can be when we talk about the different plan designs in a moment. They want the ability to access cash in the future. They've said, okay, well, what happens if we have a long-term illness, or if we need an extended care? I know a lot of people are that sandwich generation where we've got parents, grandparents that are starting to need more care as far as long-term care facilities and things like that. I know my wife's an occupational therapist, and more people are required to do a lot of these things on their own, as opposed to being admitted to hospitals, especially during COVID. I don't think my wife she works for home care, so she goes to clients' houses and see what their needs are, and they're being discharged from hospitals quicker and quicker these days. And it's certainly something that a lot of clients, I think, are very concerned about, is what are my needs going to be going forward when it comes to my health and to my long-term care. So that's something that Dale and Joy are certainly very cognizant of, that they want access to this policy values. Now, I just did a comparison of our three. When we talked about the early value versus the delayed value products, we're talking about the three early value options here. We've got a guaranteed 10 pay, we've got a guaranteed 20 pay, and we've got a pay to 100 product. We'll talk a little bit about the different characteristics of each of those types of policies. When we say a guaranteed 10 pay, and I often joke with clients, I say, if you see guaranteed in an insurance contract, it is guaranteed. There is no somewhat guaranteed, there is no sort of guaranteed, it is guaranteed. So it's a guaranteed 10 pay paid up policy. You pay your premiums for 10 years, and you no longer have to fund that policy, and that death benefit is now fully paid up. So if you look at that option with the $25,000 initial premium that we talked about, for Dale and Joy having that excess cash flow, we're going to invest that $25,000 for 10 years into that guaranteed 10 pay option. So we're going to have a cash surrender value at year 10 in this example of $210,000, almost $211,000. If we use the max 20 option, which means that the policy would be paid up after 20 years of premium payments, but we're only showing 10 years of funding here. We're using what we call premium offset. Some of you might be familiar with the expression premium vacation, which is a London Life terminology for their previous participating insurance products. So when dividends are going towards paying premium, that's what we call premium offset. That's the generic term. So we're offsetting this policy after 10 years of premiums with the guarantee of that it would be fully paid up in 20 years if for some reason there were no dividends credited to this policy, which would be extremely unusual. We also have the pay to 100 option. So the pay to 100 option, with in its simplicity, you would pay to age 100 into this contract. Now the premium offset opportunity is certainly much sooner than that, and we can also add what we call additional deposit option. So additional deposit option, we talked about paid up additions as a dividend option. What ADO, or additional deposit option, does is it allows you to overfund your policy, so that additional deposit option payment, which is totally optional, goes straight into paid up additions. So it kind of supercharges your policy values by putting that money into the policy earlier. It's the time value of money concept that many of you might be familiar with in your investment portfolios. It's the same thing with insurance. If you put that money into the policy earlier, those values are going to grow higher down the road. So with the max, for all of these options, I'm putting some ADO into this example as well. That also gives you that flexibility, because that piece is actually the optional payment. The base premium is required on an annual basis, at least until that policy can be offset. But the ADO is, like I say, completely optional, and you have unlimited opportunity on new policies to be able to utilize that additional deposit option. So that's a great feature that many clients take advantage of. So that pay to 100 policy on the bottom, we're funding it for the same 10-year period. We're going premium offset after 10 years, and now we've got a $285,000 cash surrender value at year 10. So this is where that break-even point, if you look on the far right-hand side, the break-even year where the cash surrender value is going to surpass the premiums paid for the guaranteed 10 pay is out at year 13, because we're paying more base premium in those first 10 years. So there's not as much cash value growth within that policy. For the 20 pay version or scenario, we're looking at a break-even of year 7. And then for the pay to 100 with offset after 11 years, the same funding as the other two options, we're breaking even in year 5, which is very attractive to many clients that like that idea that, like I say, their cash surrender value is now higher than what they put into that policy. Now on a death benefit side, sorry, just one second on that previous slide. Just at the bottom there, we're looking at 35 years. So this is now Dale's age 90. Joy is now 88. So we're looking at the same products, the same 3 products with the same funding, the $250,000 total cumulative premium over that 10-year period. The initial death benefit is higher on the pay to 100 because there's less guarantees in that one, the guaranteed 10 pay versus the guaranteed 20 pay. So a $418,000 initial death benefit, which many clients, kind of like that initial death benefit being higher. And then the death benefit at the comparison year out at year 35 is going to be $972 versus $984 with the guaranteed 10 pay. So the guaranteed 10 pay would eventually have the highest death benefit or estate value because you're not paying premium anymore in that policy. The pay to 100, there's still premium payable, it's just being paid by dividends. So the values within that guaranteed 10 pay, once that 10-year guaranteed paid up window is over, there's no more premium payable. So the cash surrender value then starts to catch up and then surpass the other two options. So again, depending on where the client is really focused on where they want to have the highest value, that's where we kind of help decide what product to recommend.
And I find, when we do that case consult for an individual file, often that non-registered investment account at life expectancy would have to earn a compounding rate of return of like 12% or more all through the years to equate to the same after-tax payout of the policy on death benefit. And a compounding rate of return of 8% or so is what your non-reg account has to earn to be equivalent to the cash value used in like mid-70s. So that's kind of like your opportunity cost is how we tend to look at it in terms of what your non-reg account would have to perform at to overcome those numbers here.
Absolutely. So you can see the returns with those 3 options as well, particularly on the death benefit side. We've got a 4.57%. So this would be equivalent to an after-tax rate of return for an investment portfolio versus 4.29 for the guaranteed 20 pay and 4.53 for the pay to 100. What I often focus on, because a lot of times we talk to clients that have already built up a significant amount of wealth, they say, well, I can write a check for my tax liability tomorrow. Well, we'll often say, well, would you rather pay 100 cent dollars out of your own assets, or would you rather pay cents on the dollar by utilizing an insurance policy? In this example, we're looking at 25 cents on the dollar for the guaranteed 10 pay, or 28 cents on the dollar for the 20 pay, or 26 cents on the dollar for the pay to 100 option. So this, for about a quarter of the overall asset value, we could certainly benefit by utilizing the insurance as opposed to their existing investment portfolio. So we've shown these options to Dale and Joy, and they decide they like the Wealth Achiever Plus pay to 100 because it does have the higher initial death benefit. They like the flexibility. So with the pay to 100 option as well, there's more additional deposit option room. There's more of that tax exempt room that I showed that graph earlier. Because with the guaranteed 10 pay, we're already very close to that tax exempt limit. So there's less additional deposit option room, subsequently less flexibility. So with the Wealth Achiever Plus pay to 100 with maximum additional deposit option, same $25,000 premium, the base is going to be about $9,000, whereas the additional deposit option might be 16 in this case. So we're looking at that flexibility as a great option for these clients that don't necessarily want to commit to that $25,000 on an annual basis. So we're going to give them that flexibility to offset the policy after 10 years. And this is at Dale's retirement age of 65. They can continue premium payments. And this is one of the advantages of that pay to 100 option as well. Oftentimes, if you have a guaranteed 20 pay or guaranteed 10 pay product, you can't fund that policy after that guaranteed period. There's just not the tax room available to do that. So when you have a pay to 100 option, you can continue those premium payments. You're not obligated to go on premium offset after that 10 years of funding if you have other assets that you would like to shelter from tax and move into the insurance policy, you can continue to do that. Or if you like the values and the growth of those values within that policy, you can fund it for as long as you want, up to age 100. So that's certainly an advantage as well. The start and stop of the ADO is certainly a viable option as well. You can not pay the ADO even at the outset of the policy and decide at some point in the future whether you'd like to contribute the additional deposit option. If your situation changes, you come into some money perhaps, that's when you can start the additional deposit option payments. And like I say, it's completely flexible for the client. And then obviously accessing cash in retirement if needed. And we'll show an example of that.
Yeah, in practice, it's interesting if you're in your 40s, a lot of times that 20-year payment window as an option is ideal. So it's kind of sometimes tied to your retirement or your working trajectory. If you're past 60, because this works all the way into your 70s, the concept and the numbers, oftentimes we would try to short pay that so that it's 10 payments or less. So again, it's unique and individual to each household and situation.
Absolutely.
Absolutely, and you want to take into consideration the different tax years as well to which you own the policies.
Yeah, and that expression I talked about earlier, moving it from pocket A to pocket B, a lot of times clients want to move that money into this tax preferred vehicle, being life insurance, sooner rather than later. If you stretch it out over 20 years, we can only move 1/20th of those assets over in that period of time, versus maybe over 5 or 6 years if we wanted to really accelerate that movement of the tax exposed assets into the insurance policy. So there's lots of flexibility that we can show as well. Next slide, please. So here's that same graph with this is more specific to Dale and Joyce. We've got the $250,000 over that 10 years. So we've got the $362,000 is lost to tax in this example by putting the money into a tax exposed investment vehicle, versus the $972,000 for the insurance. This is still the estate value. We'll talk about their accessing opportunity in a moment. So with the same amount of $250,000, we've got a $503,000 difference or advantage for the insurance over the investment portfolio, or 107%. And again, this is at a 4% fixed income growth rate, showing allocating a portion of their fixed income portfolio into the insurance policy versus the investment. Next slide, please. So again, here's the chart where we're talking about transferring assets using the investment versus the life insurance. We've got the annual growth due on the non-registered investment, tax on any unrealized capital gains upon death, and the net estate, or the net benefit would be going to the estate. On the right-hand side, transferring using life insurance with no growth within the insurance policy, and then the beneficiary would receive that benefit tax-free. Next slide, please. And here's a chart that shows that green line is the death benefit of the life insurance. And the reason why a lot of people will ask, okay, that green bar kind of peaks at year 8 in this case. So it should be year 10. I'm looking at the graph correctly. Yeah, it's year 10. So what happens at that point, because we're going on premium offset, we're actually seeing a slight dip in the death benefit, because what we're having to do is surrender some of those paid up additions. We talked about accessing cash through surrender of paid up additions a little bit before. We're surrendering some of those dividends to pay the premium. So we're seeing a slight dip, and then it starts to rise up again in the later years. The dashed blue line is the CSV, or the cash surrender value of that policy. So you can see that it's exceeding the investment portfolio, like I say, at that break-even point, and it eventually equalizes the death benefit within that life insurance policy at age 100. So the non-registered asset is not able to keep up with the cash surrender value of the life insurance policy after that break-even point. Next slide, please.
That's a big thing to remember, which I think you're going to talk about some of those assumptions. But when you look at some of the, if you were in the last session, we're looking at a par account return of almost 7.5%. You're looking at a dividend rate of 5.25. That it's just increased to. That's, when you start looking at an outside investment taxable, it's a lot higher, which you're going to talk about right here.
Absolutely. Yeah, so these are the assumptions that I've made. To Pam's point, we credit the investment component of the participating account, and maybe I'll go into just a brief explanation, which I find clients often appreciate as far as explaining how dividends are credited to a policy. I talk about 3 major components that go into a dividend of a participating life insurance policy. And sometimes I use a 3-legged stool analogy. where one leg of the stool is the investment performance, and that's that dividend scale interest rate or the investment component that Pam was referring to. Currently, we're crediting 5.25%. Sorry, as of July 1st, we'll be crediting 5.25%. It was 5.1% up until July 1st. We're the only carrier in the country that has actually increased their dividend scale interest rate this year. And that's due to the makeup that Ryan Marcy would have talked about yesterday as far as the investment component and the growth, the 7.5% overall par account yield that we experienced in 2021. So with London Life policy specifically, if you have an existing London Life insurance policy, participating life insurance policy, up until July 1st, the crediting rate for that was 4.85%. That is also increasing to 5.25%. So that is a big jump for existing London Life policy owners for participating life insurance policies, that their dividend is now going to be based on the 5.25% investment component. The second leg of that stool, and I don't think in the insurance industry as a whole gets enough attention, is things called mortality experiences, another major component. So every participating insurance carrier has to predict with their actuarial assumptions their mortality experience. And Canada Life is a very conservative company, as you may already know. So we tend to overestimate the number of death claims we're going to pay out in a given year. So if our actual experience is less than what our assumption was, that can be paid out in the form of a dividend as well. That goes into the component of creating that dividend on that dividend scale. The third major component of the dividend is things like taxes and expenses and contributions to surplus and things like that. So all three of those components go into the actual dividend credited to a policy. So oftentimes, like I say, in the industry, people will talk about just the investment component in isolation, and that's really the only thing that we can adjust on an illustration is what the investment component is doing. But it's those other factors as well that plays a big role in the dividends of an actual policy. So it's important to remember that all three of those components, those major components, and there's some other subsidiary actions as well that play a role in the dividend scale. But those are the three major components that go into it. So going forward, being a conservative company with the investment philosophy that we have within our par account, we feel that we're well positioned to go through every potential financial crisis. We've obviously gone through the 2008 crisis. We've gone through many financial situations that we didn't anticipate, but we're positioned properly to be able to go through those and go through them relatively unscathed, relatively speaking. So just talking about some of those, sorry, go ahead.
Yeah, I was just going to say, although it may sound funny, like I think that the boring, simple, stable nature of the company and the protocols is very exciting and appealing and sexy to a point, like related to what it contributes to a financial plan. What we're not talking about is that it doesn't really have a tie to the public investment markets. So this is a great way to shelter those stable assets and stable growth expectations, enabling us to take some risk in other areas of your net worth or your financial plan.
Absolutely, yeah. So these are the assumptions that I used for this particular example. We've got our client ages there. We're using a $25,000 annual premium with that WellSelect Pay to 100. And I showed 100% going into a fixed income portfolio with a 4% growth rate, tax at 48%, the highest marginal tax rate here in Alberta.
Yeah, and of course that's after tax.
That's right, yeah. So the comparison is going to be the after-tax estate value for the investment component. Next slide, please. So just to summarize, with that estate transfer strategy, we've shown that we could save $362,000 in potential tax by utilizing the life insurance instead of that non-registered investment, instead of leaving those assets in that tax-exposed investment vehicle. We've added $503,000 in net estate benefit to their beneficiaries, which I think most people would find as an added bonus, 107% advantage over the non-registered investments at that 4% growth rate we referred to. And you also have $285,743 in cash value that's available for you to access versus $280,000 of total asset within the investment component. So you could use all of those investment assets to provide an income, but we're only going to be talking about the cash surrender value of the insurance policy, and we're going to show how they can access that particular value next.
And the earlier you start, the better. So that's where it's, again, like my favorite concept is almost like the cascading concept, where insurance value on kids or grandkids just creates a whole powerful flow of funds towards the whole lineage.
Absolutely. So when you access cash value from a policy, it can be a one-time short-term cash flow need. I know during COVID, a lot of people access policy values within their policies just for a very short term, whether it's an employment challenge, income, drop in income. I know a lot of corporate clients had extreme decreases in their revenue. So it could be one time, or it could be a series of withdrawals or policy loans from that policy to supplement retirement income, or can create another tax advantage account and use for any unexpected life events. Like I said, that long-term care expense that might be somewhat of a surprise to some clients in their later years. So it's an alternative to accessing income from other assets. And we'll show the examples here. So policy loan, and I often talk about policy loan being the simplest and the easiest way of accessing policy values. It is contractual right of any policyholder that they can take a policy loan against the cash value of their policy. And I oftentimes say that, you know, the only question Canada Life is going to ask is, what address would you like to send the check? Now, I guess in today's world, we're not necessarily sending physical checks as often. Where would you like us to send the electronic transfer, I guess would be the new terminology for that. So again, you make your payment into your insurance policy. The policy is going to grow tax-free. The loan is tax-free up to the adjusted cost basis of the policy. And every policy has an adjusted cost basis, essentially the cost that you paid into that policy. There's a complicated calculation, and each policy, we can show you what the ACB is. So the policy loan would be tax-free up to that point. So if you had $100,000 of cash surrender value, as an example, in your policy, and you had a $60,000 adjusted cost basis, you can take up to a $60,000 policy loan, or a series of loans, up until that $60,000 tax-free. Anything above that $60,000 ACB is going to be taxable.
So
that's something that's important to know.
One option to access the cash. Normally we see policy loans if it's a short-term need, like let's say 3 years or less, and speed of delivery is key. And then we just grab it, and you mentioned it gets delivered within 3 to 5 work days.
Yep.
And a question we get asked, and we're seeing here is, you know, can I use my bank? You know, and that definitely is something that, you know, they will take this as full collateral, not quite full, but, you know, difference of 5–10% of your collateral, depending on the bank. I know TD just did one for one of our clients, and I was kind of thinking they'd come in at the 90%, and they came in at 95%. You know, so TD will do this quite well. A lot of people have used CIBC and RBC in our 25-year history here, and it's worked out just the same.
Yep. Yeah, collateral loan is certainly an option, and it's a tax-free option as well that we'll talk about in a moment.
Yeah.
So the tax-free, so if there's a policy loan on a particular policy, and we can capitalize the interest of that particular loan. So the balance plus the loan interest would be paid out upon death automatically to repay that loan, and the remaining death benefit would be paid out tax-free to the named beneficiaries. So that's something that can be very valuable as well if clients didn't need that full value of the insurance policy and they wanted to take out some policy loans to drive an income. Next slide, please. Second option is partial surrender of dividends. And this is what we talked a little bit about with those paid up additions. So if we surrender some of those paid up additions, we can also create an income. So the policy is going to grow exactly the same way. When you partially surrender dividends within the policy or do a cash withdrawal, it's a prorated taxation, which means that if you were to fully surrender your policy, there would be a taxable gain. So the taxable gain might be 60% of the entire, let's say you had a $100,000 cash surrender value with a $60,000 ACV, your 60% of your, 40% of your withdrawal would be taxable. So if you only did a $10,000 partial surrender, 40% of that withdrawal would be taxable. So there would be a taxable component on a prorated basis when we surrender dividends. The one thing that clients need to be aware of with this option as far as accessing policy values is that once you surrender those paid up additions, you can't then repay it back into the policy and get those paid up additions back. So this is a more permanent reduction in the overall coverage within that policy, but it does provide that income on a tax preferred basis versus an unregistered portfolio, because you're only paying a portion of the tax on that. And then again, the remaining death benefit would be paid out to the beneficiaries. So this is the collateral loan concept, and we talk about this very often. And a lot of clients really just as a point of reference, they just want to know that they have full access to that policy. And this is where Pam's talking about with the third-party lender. And we deal with a lot of lenders that are very comfortable with lending against participating life insurance policies. You may have heard previously that once dividends are credited to the policy, they're fully vested. So when banks are looking at participating insurance policies that have a particular cash surrender value, that they know that cash surrender value isn't going to go down. So it's not volatile like even a universal life policy that might be invested in more of an equity portfolio. You're going to see steady growth within that policy. So banks are quite comfortable borrowing against that. And as Pam said, up to 95% in some cases. So you can take your policy to a lender. And again, it's lenders that understand how this type of insurance works. So TD, RBC, BMO, Manulife Bank is another lender that we use quite often. Equitable Bank, not to be confused with Equitable Life, is another lender that really understands insurance lending as well. So we've got a number of different carriers if you did want to access your existing policy values that we could approach as far as lending against. So when we take that collateral loan, there is no tax component because we're just using the policy as collateral. So there's no distribution, there's no tax trigger on that policy itself. So the loan is tax-free. You pay the interest, or you can capitalize the interest on top of that loan, and most lenders would allow you to capitalize that interest. So you'd have a growing outstanding loan balance, but you've also got a growing cash surrender value of and death benefit of the insurance policy. So upon death, whatever indebtedness there might be with that existing loan, because you're collaterally assigning that policy to the bank would be paid off that indebtedness first, and the remaining death benefit would be paid to the named beneficiary. So it's a great way to access policy values on a tax-free basis. You're going to be having a lower net death benefit potentially because we've got that outstanding loan, unless you decide to pay back those the interest and principal during your lifetime. But upon death, you'd still have that net death benefit going to the beneficiaries.
And typically we'd see this again, in your 70s, lower rate, more paperwork to get it set up, but a more preferred way to access the retirement income stream. And it would be quoted within a year of actually procuring the cash for that retirement income.
Right. So again, very popular with many clients. So if we look,
we even have people that I was just going to say quickly, that want rental properties or want different properties or, want to fund properties for their parents. And, they're like, I don't know what else to do. My parents are in this situation or that situation. Or it's like, I'm looking at that retirement cottage now and I'm debating on how I can take my RSPs and everything else. That's something else that you can factor in and give you a bit of a break on that initial section and say, okay, you know what, we might take assets from here or there. And that gives you a lot of flexibility.
Absolutely. So would Dale and Joy look at this option? They like the idea of the collateral loan. They like the idea that it's tax-free and they could help supplement their retirement income. So if we show income starting at Dale's age 70, so we talked about him retiring at age 65. So they're going to fund his retirement for the first 5 years. We're going to start accessing these policy values at his age 70 or 5 years into his retirement. And we're going to have that income going for 15 years. So with the $250,000 of overall cash invested into the investment portfolio or premiums paid into the policy, we're going to take the same amount of income out of each of those options. And this is $221,000 almost in each of these cases. So the net value at death to the beneficiaries when the investment component would be $173,000. But even though we've got a $220,000 outstanding loan on that life insurance policy, we still got a $457,000 net death benefit paid to the beneficiaries. So this is a really valuable component of being able to not only have the access to the cash value and provide that retirement income, but also have that estate value that would go to the beneficiaries or to the estate to pay tax liabilities, et cetera, or leave that legacy, whatever their other goals might be for the policy. So when we look at the internal rate of return, it's only 2.08% in the investment component because of the tax exposure of those non-registered investments. And it's 4.07 after we've utilized the cash flow from the insurance policy. So on a net basis, we're looking at 37 cents on the dollar for the cumulative net cash flow plus that the net value at death versus 63 cents on the dollar for the investment component or for the investment option. Any questions about that? Any questions about anything?
If you have any questions or you want to put in the chat section, you can definitely do that now, and we're happy to field any questions that you might have.
I have nothing at this time, you guys.
Well, and just for the record on that last slide, it was a significant difference. I think what we've come to know is that insurance isn't the only solution, but it's a valuable piece of the planning puzzle, especially when it comes to managing tax.
Yeah, absolutely.
And when it's half the cost on the dollar, you kind of go, that's a no-brainer when we're when we're under 40 cents on the dollar of what it's costing you, it's like, well, there's the numbers proof right there.
Yeah, well, and it's certainly challenging in today's environment to be able to select the right investment portfolio that's going to be able to get through the times that we've been through, both from an equity standpoint and our fixed income assets. We keep seeing all kinds of things about how fixed income portfolios aren't going to be able to keep pace with inflation if we're going to start continue to see the inflation numbers probably not being at the current levels continuing, but they're going to be fairly significant for the next period of time. So to have that opportunity to maximize their overall investment portfolio and using insurance as part of that is certainly very valuable.
Yeah, definitely. And that's what we've been seeing. And we've been having more and more clients who are like, geez, I wish I did more. And that's often, what we say to people is if you can start it young and start it at a scary dollar that you're used to, it's like, it's usually beneficial in the end. Most people wish that they had done more rather than less. So, and it gives you a lot of flexibility in the end, as well as that if something happened to you and you're laying in the hospital, you're not really going to care about the rate of return on your investments as much as you'd care about what's going to happen to my family, what's going to happen with everything, is everything going to be okay? Can I leave, the hospital money that I want to leave money to, and things like that. You tend to find that's the final question we get asked. And that certainly gives you all that flexibility.
For sure. Oh.
Thanks, Barry, for your participation, and we want to thank everybody for attending, and we'll see you again at the next webinar.
Thanks, everyone.
Thanks so much. Thanks again, everybody. Bye.